Welcome to the Vital Dawn podcast for Monday, June 28th. U.S. equity futures are essentially unchanged for the most part. S&P futures are up about a point. Dow futures are off 20 points. That's about 5 basis points. The NASDAQ futures are outperforming modestly, up 33 points. That is about 23 basis points. So mild outperformance in growth this morning. That follows Friday where growth lagged. Although if you look back over the month of June, growth is massively outperforming cyclicals by about 500 basis points. I suspect that theme will continue with growth continuing to outperform largely because of this peak everything thesis that I've been talking about. Although as we go into the final days of June and Q2, you may see just a modest reversion back to cyclicals, especially in anticipation of a very strong jobs report on Friday. But in general, I continue to think that growth will stay ahead of value over the coming weeks and months. The major European indices are trading down about 30 to 40 basis points. You are seeing underperformance in Europe in a lot of the cyclical groups. So autos, banks, energy are all underperforming. Banks are down about 1%. You are seeing outperformance in Europe in areas like healthcare, telecom, and utilities. Asia was mixed, nothing dramatic as far as the overall moves, relatively steady, quiet. And that goes for the whole morning, really, for the most part. There's not any real major macro developments to talk about. The one area of incremental news concerns U.S. infrastructure spending. I consider this to be more noise than anything else. If you kind of just take a step back and look at where infrastructure spending stands, I think it's largely where it was on Friday. You did have, last week when this bipartisan agreement was struck, you had Biden come out immediately and say he will not sign it unless there is a separate reconciliation bill, essentially attaching a poison pill to it. He came out over the weekend and clarified and said that that's actually not what he meant, that he will sign the bipartisan agreement, but he still will push forward on a separate reconciliation bill. Again, Pelosi has been pretty adamant that she will not allow the bipartisan bill to come for a vote unless she also receives the reconciliation one from the Senate. So I wrote a lot about this over the weekend. I sent around a separate piece. It's also included in the Vital Dawn this morning. So reach out if anyone needs it. But I think, needless to say, we're kind of back really at square one, where, again, you have Pelosi and Schumer both kind of attaching conditions to this bipartisan agreement whereby they won't permit it to advance without this reconciliation option. Again, I think stocks care most about tax hikes. I think at the end of the day, large tax increases, the odds of that occurring are low, and that's what stocks care most about. The question is whether or not you get about 75 to 100 billion of increased infrastructure spending annually. And I think that's kind of your big wild card. So stocks, we really are okay with either scenario. Either, nothing happens or you get that modest bump to infrastructure spending. And I think that's why you aren't seeing too much anxiety or focus around that whole topic. Nothing really all that new to say about with regards to the Fed. I think, if you go back a couple of weeks, back on the 16th, you had the new dot plot that created some anxiety around rate liftoff. You had those Bullard comments on the 18th on Friday in CNBC where he mentioned about how rate hikes could start next year. I think you've had over the last week some soothing remarks from Fed officials, including Powell, who testified last Tuesday. So now the focus is back on just the tapering schedule. I think the rough consensus assumes that you were going to get communication on tapering at Jackson Hole and then at the September meeting. You'll have tapering begin in December, and it will occur at about a $15 billion per month pace, which means that you'll wrap up asset purchases by the middle of 2022, with rate hikes starting in 2023. I think that is the rough consensus for the moment. And so to the extent anything causes those expectations to change, obviously that will be important to watch. The next major Fed event is probably going to be the jobs report this Friday. The consensus is in print right now at 700,000. The whispers for, throughout last week have been kind of creeping higher. We'll have to see how some of the job indications this week come in, including the labor component of the ISMs. You have the ADP report and then the weekly jobless claims. But, again, if you have 1 million plus additions on Friday, obviously that's going to create a little bit of anxiety around Fed expectations. But inflation obviously is super critical too. The PCE on Friday does suggest that you are seeing some of the momentum in price increases begin to plateau. That hopefully will translate into CPIs and PCEs going forward, in terms of the year-on-year increase beginning to flatten out and then descend off of the recent apex. Largely because of base effects. The base effects are at their most extreme right now, so that's going to diminish going forward. Then you have just other indications that global supply chains are starting to respond to the surge in demand that occurred around reopening. And as they do respond, that should take some of the pressure out of the supply chain that's been driving prices higher too. So those are kind of the major themes and trends. Like I said, relatively quiet as far as big headlines are concerned. No major micro headlines to really note. A couple of interesting things, but nothing that's really going to sway the overall tape. Looking at the calendar for today, Monday, June 28th, there's not much with the exception of bank capital return announcements. So you had the stress tests that were out last Thursday night. Normally, you have the banks come out with their capital return announcements, buybacks, and dividends the evening of the stress test. This year is a little bit different. It looks like the banks will start tonight making their capital return announcements, so dividend hikes and buyback hikes. It's widely expected that you're going to see these numbers move up a lot. The Fed capital return restrictions lift as of July 1st. The stress tests were all pretty solid across the board. Banks are very well capitalized, and obviously the economy is enjoying a lot of tailwinds at the moment. So you had the banks rally on Friday. You may see a little bit further outperformance, but again, I think that the rallying banks will be faded largely because of earnings headwinds in the near term. You are probably going to see street estimates get cut as sell-side previews get published ahead of the earnings season, which kicks off in pretty much just 2 weeks at this point. And then just Treasury price action has been unfavorable for the sector. So that's going to be the only major scheduled event for today. Those bank capital returns after the close. For the week overall, the big events include the China PMIs Wednesday morning, the Eurozone CPI Wednesday morning, U.S. manufacturing ISM Thursday morning. You have an OPEC meeting on Thursday, and then the jobs report Friday is really probably going to be the big event of the week, the real highlight of the week. And then that is pretty much it. And just kind of, so the jobs report on Friday, and then you have the June U.S. CPI next Tuesday. On July 13th. And then you're kind of into earnings season also that morning of Tuesday, July 13th. So those are really going to be, I think, the next major events that will determine the direction of the market. So that is everything for today, June 28th. Thank you for listening.